You're listening to Pre-Market Prep. I'm Brianna Valesky in for Joel Elkanan. Thank you all for your patience while we experience some technical difficulties. I'm on with my co-host Dennis Dick, and we are joined by Anne-Marie Baiynd. She's an author and financial analyst. Anne-Marie, how are you doing on this Monday morning?
I'm doing well, enjoying the fall.
Absolutely. There's hardly anything that can compare to a Michigan fall. Well, right as our internet went down, we were looking at Eli Lilly. And I don't know if you've been watching the stock
Yes.
this morning, but it was halted and then resumed trading after they came out with news that they are going to stop production of this drug. What are your thoughts on this issue?
Well, I actually was watching it, and I sent out a tweet. I said, hey, listen, watch it come into 77. We should find a group of buyers there. That should be support. And it
Mhm.
lost the level just for a moment, but buyers have picked it up at the region. I can't really comment on what it is that I think that's going to do to Lilly per se in terms of lost revenues and whatever, but certainly the big number here is, can it hold this 77 region? Because it's the last place that a lot of major buyers took off and said, yes, we're getting invested in here. And so they're going to have to be faced with the decision about cutting and running if they haven't already done so. Because you could see technical momentum was showing that this chart was in a little bit of trouble as it was making new highs. And so from that perspective, really the proof's in the pudding here. For me as a trader intraday, I can say, hey, listen, the bid-ask seem fairly wide here, really, even as things move around at this 77 slot. But if you try to pick a bottom here and it can't raise up off of that within 30 minutes, because this is a big deal, it's a big number. If they can't do it, you've got to cut and run and watch for the lower high to make for the short. That's my thought anyway.
And I agree with you here, Anne-Marie. It's a huge number for it, $77. And the one concern I have, and I was an Eli Lilly shareholder here for a long time. I've had Eli Lilly for 5 years. I finally sold my last shares just a few weeks ago, up at $88 because I was like, this is one stock that seems to be like the honey badger. It has not been hit. It's been held up, considering what's happened to the big pharma, considering what's happened to biotech. Eli Lilly really has not been hit. Now you get a piece of bad news here, and I wonder if this doesn't start to get other people thinking the same way that I was thinking, is that eventually this one could get hit as well. And it obviously is getting hit here this morning. So I think it is critical that it holds at $77. If it takes that out, then you start to get concerned, because if you really put it in perspective, it's been a nice run here for Lilly over the course of the last 5 years. We were down in the $30 area just back in 2011. So here we are at
Absolutely.
$86. A lot of other biotechs have been hit hard. Lilly hasn't. So now you get a piece of bad news that can scare a few people away. So 77 is large.
Yeah,
Anne-Marie,
definitely.
just want to ask you too, what are your thoughts here on the overall biotechs in this sector here? Because if you look, when we've been talking on the show, a lot of laggards, a lot of stocks that have been lagging have actually caught a bid here the last few weeks, but really the biotech stocks have not. If we look at a Biogen, BIIB, we look at a Celgene, like especially Biogen. Let's just stop at that one, BIIB, because this is really a great example. This stock is just, within striking distance of its 52-week low, and it's been a nice rally for the overall market, a nice rally for some of the laggers, a nice rally for some of the commodity stocks that have been beat up, but biotech really hasn't rallied. What are your thoughts on a stock like Biogen? Why can't that catch a bid?
Well, I think the big thing to look at when we consider charts like this is we've got to widen the angle on it. So we can see that, certainly it is not catching a bid. And if we expand and we say, all right, well, what's the chart been doing over the last 3-4 years or whatever, we can see that really 2000, what is that, 2014 was sort of a sideways year a little bit. It came from the top to the bottom, back to the top in that space. And now it's coming down really just to 2013, 2014 levels. And so really this chart had such an expansive run that
Mm-hmm.
I believe that it's really going through its own cycle of relative reversion to the mean. If you look at the 100-day moving average or the 200-day moving average, but maybe you look at it from a weekly perspective. And let me pop that in so I can be sure. 100 week. Let's see what that looks like. Well, the 100 is still really, it's very, very high. Still, the 100 weekly moving average is $336 still, and it's down below that now. But my thought is this: we're looking at last year's lows, essentially, and we're trying to bounce off of those. We've had 3 attempts at bouncing up,
Yep.
but for me, I will look at relative return. What is it that the chart is likely to do over the next year based on the prior years? And Biogenetic has been doing so well that it's just got to revert to its normal means.
Yeah.
And that, at the end of the year, I will look at almost every single stock I follow or every single instrument that I follow, and I'll watch it. And outside of the ranges, it's kind of like early in the year I was talking about IYR pulling back because it was just outsized returns, something like it was an ungodly number last year that it popped up. And so I said, these things have got to revert to their mean. It's like the batter that comes in the first 2 weeks and he's at 412, and you're like, whoa.
Great
and,
analogy.
at the end of the season, he'll be at 263.
Yeah.
Because that's really how it works.
Yeah, in the long run, and I completely agree with you. I mean, you look at 2009, 2010, 2011, Biogen is a $40 stock. Then it goes to
Exactly.
480 in the course of 5 years. We're talking about over 1,000% gainer. That's probably not sustainable. So when you look at it here, 269. Well, if you bought at 40 in 2009, you're still up significantly on this position. So it doesn't look as bad. You bought in the last year, and you hate the position. So
Yeah.
yeah, it's always nice to go to those monthlies and really get perspective on if you're chasing price or not. Because when you look at a daily chart, it may not look like you're chasing price, but when you look at a weekly or a monthly on this thing, you're still chasing it a little bit, even at 260.
Absolutely. Absolutely. And here's the big thing, and I tweeted this out. Because of what I see happening in the market over the next year or so, the big deal for swing traders, short-term swing traders, intermediate swing traders, it's all going to be about finding the stocks that are overvalued significantly and shorting them, or finding the ones that are undervalued and waiting for them to come into those proven buying levels to pick it up. Otherwise, it really is going to be a really, really rough year for swing traders, in my mind.
Anne-Marie, Sheldon McIntyre in the chat is asking, how do you define the mean?
How do I define the mean? Okay, so you look at the rate of return from January to December. Really, it could be March to February or whatever. Just pick any 12-month period and look at the rate of return and look at it year over year. So this year it went up 12%, or I'm just talking numbers out of a hat. Next year it moves up 14% year over year. The third year it moves up 44%. Guess what's going to happen on that fourth year? Yeah, it's going to revert into the mean, because charts don't expand rapidly away like that. It's not the nature of market structure. It doesn't do that. And so it might do it for a while, but you have to remember that if you're in an expansion space, that expansion is going to exhaust as a stock rises. And so it could rise into a new mean, a new rate of return. See, the chart could be doing 6-8% and then jump to 30 and then pull back, and all of a sudden now it's 18 or 20% rather than the 6, because of the chart's own growth potential, the company's own growth potential. But that really is what you want to do. You want to look at what was the price January 1, what was the price December 31st, what's the rate of return there? Let's look at it year over year and see if it's outsized. If it's outsized, gigantic expansions are going to get sold off. And you can even see that in 2014 with Baiynd, as it really expanded in February and March of that prior year, and it pulled right back down into that 100 moving average, popped just underneath it, and then sort of stumbled its way around there for the majority of the year before popping right back up. And it did the same thing, hyper expansion. This time, this one happened in March, and then it rolled over. Charts are very cyclic like that. They make the same kinds of behaviors over and over again.
Sheldon also asking you here, we got a bunch of stocks coming from the chat, but Sheldon asking you about gold and silver. And we know gold has had a nice run. Even silver over the course of the last couple of weeks has finally caught a bid here as well. What are your thoughts here as money is finally moving into some of the precious metals?
Well, again, let's go back to the weekly chart. You know, my sense is that these charts are building a bottom. They are building a bottom. For gold, and I'm always going to use GC, the gold futures, as opposed to GLD. As I look at gold on a 10-year chart, it really is moving its way into a resistance zone where a majority of folks just tried to put in support, but now it's resistance. And that area is about 1166.40. So my thought is, based on this kind of formation, that any big expansions up are going to get sold off. But they're going to get sold off into higher lows. So if you're looking for momentum, don't take the breakout action here. It's too weak. First of all, there are a ton of people that have been long gold and think about being long gold all the time, and they're still trapped long. And so finally, they're holding out into spaces. They've had so much emotional damage put on them by the losses that when they come into those close to break-even spaces, they're going to cut and run. They don't have the emotional strength or depth to keep long right now, but you look for the higher low and that should pull in. And I think that's both true of gold and silver. The bottoms are trying to be made. I just don't believe breakouts should be bought at this time. They're all getting pulled back. If you look at anything that looked like a breakout, you can see the retrace, particularly if you look at the daily or the weekly chart.
Anne-Marie, another stock coming here from the chat. SF Bright wants to know your thoughts on General Electric. I want to know your thoughts on General Electric too. They report earnings here on Friday. Stock has had an incredible 5-day run ever since Nelson Peltz announced that he has a position in there, and it has been one of your better performers here in the last week. 3.28% dividend. There's some things to like there. The only thing I've noticed from an order flow perspective, a lot of institutional selling pressure in this $28 level. Again, I see more orders up at the 28, 25 area, just when I'm looking at the open book. Seems like there's some institutions willing to take some profits here on General Electric. What are your thoughts here on GE?
Well, I think it's at the top of the trading range for sure, and the trading range goes back really into 2014. So here's the thing that I believe. I believe that emotional candlesticks have a tendency to retrace. And so if you look at the weekly chart and you take a look at GE, it's a monster. It's a beast of a candlestick. The last beast of a candlestick that we had like that was sitting, what is this, 824 that week that started on 824. It really moved down and retraced, and now the chart is back up at a resistance level. That resistance level has normally found sellers. Certainly we can see from a range-based perspective, if we just put it up on the weekly chart, we're at the top of the range. So buying a breakout here, not going to be that pretty in my mind. So here's the thing. What do you expect? If you see that institutional order flow that is saying, I am going to take some profit, then you got to think about, well, where is my support level? And the support levels are sitting in two different spaces. Remember, when a chart breaks out and leaves a gap, it's like a three-legged chair. Not that it can't build stability there, but it's usually fairly rocky. And so we've got pullbacks 27.12, 26.20, something like that, and we've got a flat 50 simple moving average sitting right there. And so my thought is, listen, this chart is not going to break out and run for the hills to the upside. It's just not going to do that. There are no big catalysts for that. People get interested because somebody says, hey, listen, I'm investing here, but he might have a 3 to 5 year plan, right? He's not looking at a 2-week plan, right? So you've got to think about that and say, all right, well, let's let the blow off come here. Watch it come back into that 27 area. Anticipate that it might really come back into 26 and then stage along off of that. And it really is just in, what is it, earnings when today?
Friday. Friday has earnings.
Friday.
So you got
right?
a few days before the earnings report.
Exactly. You know, my thought that any range expansion off earnings is going to get sold. And it'll pull in some kind of higher low where people will put more money to work from a value perspective. That is my thought there in GE.
We've been on the line with Anne-Marie Baiynd. She's an author and financial analyst, and she joins us just about every other Monday morning. Anne-Marie, thank you so much for joining us on the show. Thank you for your patience with our technical difficulties, and we will have you on again soon.
Always a pleasure.
Thanks, Anne-Marie.